when it comes to net worth, 2/3 of all net worth typically come from home ownership. When it comes to comparing net worth, the net worth of a homeowner is 40 times that of a renter.
If you are wondering about the housing market, if now is a good time to buy, if mortgage rates are going to drop, and what's driving rent prices, today's discussion is for you. I'm Ed D'Agostino, and today we'll hear from my good friend Barry Habib, one of the country's top housing and mortgage experts. Welcome to Global Macro Update. Barry Habib, it's always good to see you, my friend. You are the definition of a polymath. I don't think I've come up with a topic that I've been able to stump you on yet, but you are the expert in housing and mortgages. So let's dive into that. And I'm just going to give you the biggest softball question in the world, because I think what people want to know is what the heck is going on with housing right now? Where are we at? And mortgages. A lot of people, younger people, feel like they're so expensive. What can they expect in the years to come, Barry?
Well, they're right. It is expensive. And we have seen a very large increase in interest rates from where we were 3 years ago, clearly. But they have been improving. So they have been coming down. I anticipate maybe we get a little bit more of a benefit and they come down a little bit more, and that will help. Now, I don't expect home prices to come down, but what we really have to understand is how to view home prices. There's a lot of negativity out there. The first thing people should not want is you don't want home prices to come down, really. And I know people say, well, we need home prices to come down. Those are individuals that didn't live through periods of time when home values came down, because having those periods of time is terrible for the economy. It means people don't want to purchase a home because people don't want to catch a falling knife. It means people are trapped in their home and they can't get out. Now, fortunately, we do not have the makings of that at all. Another thing we have to be careful of is the measuring stick that's used. Oftentimes, people look at what's called the median home price. That's different than appreciation. Median is exactly what it implies. If you take all the homes in an area or nationally that are sold, if you would line them up from lowest to highest, the one in the middle is median, meaning half the homes sold below that number, half the homes sold above it. So it is possible for home prices overall to be increasing or appreciating. However, if there are more homes sold that are lower priced homes, which happens from time to time, well, then the median price declines, even though they're appreciating. The media often confuses this. People often confuse this as well and say, oh, well, home prices are declining. Not the case. So we know real estate's local. We know in every zip code, it's going to be different. But if you were to look at this nationally, home prices are still appreciating, however, at modest levels. Now, that presents actually an opportunity. And you wanted me to speak to those young individuals that are looking at this. And I know that it's challenging. But what I will tell you is this, is that when it comes to net worth, 2/3 of all net worth typically come from home ownership. When it comes to comparing net worth, the net worth of a homeowner is 40 times that of a renter. And when you're going to compare just on monthly payment, absolutely, I know it's hard because monthly payment will likely be greater and perhaps significantly so on a purchase. But the benefit of that is you lock in that payment. And then over time, rents go up and they eventually eclipse it. Now, that's even more important when you consider the components of the payment of a mortgage, because you have principal, which is your own money, like a forced savings account, and then the added tax benefit that you receive as well. So really, when you kind of narrow it down, the payment differential might seem initially to be great, but it isn't as much as you think. And then eventually it becomes cheaper than if you were to rent. And then there's the biggest payoff of all, is the equity appreciation and the gain. And I'm sorry to just go off completely here on this, but I just want to bring up one more point. I looked at some numbers just recently because they came out from Case-Shiller. And Case-Shiller is kind of the gold standard on appreciation. You look at the 20 city index, you look at the national index. And again, the caveat here is, your mileage may vary, right, depending on the zip code you're in, because they're different everywhere. But we can't go to every single zip code. So as we take a peek at the more broader indices, and the way to look at it more broadly, when you look at the numbers for the past, let's just say 3 years or 5 years or 10 years, they're enormous. But that's not the whole story. You see, taking a look at, let's just say, the averages for the last 3 years, it's over 10%. However, That's 10% on the price of the home. That means if you paid the home 100% cash, no mortgage, you wound up making 10%. But wait a second. What if you put 20% down? Your return on equity wasn't 10%, it was 50. If you put 10% down, it was 100. Now, you have to pay for the borrowing of money, but you also would have to pay if you were renting somewhere, right? So when you're making that comparison, you're paying to live there. That's what makes the return of this different than a stock. So your returns have been incredible. And that is why so much wealth is created. And I wanted to start with that, Ed, because I think it's important to understand the difference.
Let's talk a little bit about the ways you can measure or define expensive, right? Because back when I was young, way back when, newly married, my wife and I were looking for a house. One of the yardsticks that our mortgage broker would say to us is, look, you want to stay below 30%. You want your housing costs to be below 30% of your income. And that seemed prudent, but that number is pretty unattainable in today's market. So is it that houses have just gotten way more expensive, or is it more that wages just haven't kept up with housing prices?
Interestingly enough, because I know it's hard to believe, but because incomes, of course, have gone up over time, it affords you actually a greater portion of disposable income because there's disposable dollars. You have your fixed costs and then you have your disposable dollars. So right now it's closer to, instead of 30, and you're 100% right, and the advice that you received was dead on, now it's closer to about 33%, where in some cases it could go a little higher than that. So about a third of your monthly gross income before tax, if you looked at that for principal, interest, taxes, insurance, and if there's mortgage insurance as well, that's a pretty good level to stay at. And while I understand it can be challenging to get there, it's important, really important to get into the game, because if you don't, you fall behind, even at muted levels of appreciation. And by the way, I think those levels of appreciation will accelerate a little bit, and even modest. If you think 3%, 4% appreciation, remember, because of the leverage, that could amount to 15, 20, 30, 40% on your investment that you're putting in, on your down payment. So you want to make sure that you're in the game to create net worth, to create wealth, and also you keep up with the appreciation in home prices, because eventually, as you want to move into your next home, you're keeping up with the home that you're going to be jumping into, because both of those will be appreciating similarly.
But I think the reality for a lot of, and I'm not just talking about homeowners too, I'm also talking about renters, right? That cost of housing, I think the average is closer to 40% when you factor renters in as well. So, that's a big part of the housing market, right?
And it also brings up a great point, Ed, because if you're spending that much on renting, it's making it difficult to save for a down payment. Now, there was a survey that was done about a year ago, and I just found it very fascinating that 45% of potential first-time home buyers, 45%, Ed, thought that you needed a 20% down payment to purchase a home. And it is that misconception that potentially has kept them out of the market. In fact, you could buy a home with very little, 3.5% down. So while, of course, that means that your mortgage will be larger, your monthly payment would be larger, but it does potentially get you over that hurdle of, hey, do I have enough of a down payment to purchase the home? So this could be a real benefit for people that are looking to buy a home. Another thing too, Ed, is that investments of real estate can be wonderful. Nearly 1 in every 6 transactions currently is an investment property. And people are finding that that is a great way to create generational wealth, because, people who have a lot of investment property, they call them doors. Oh, I have 4 doors, I have 20 doors, I have whatever. But these investment properties put them in a position where, the rents continue to go up, their fixed costs stay here, the appreciation levels come up, and then you could actually pull money out in buckets, because you can refinance, you could pull cash out. So these are terrific. And here's the other thing that very few people know. This was in the One Big Beautiful Bill Act, as it was codified that you could use a segregated cost structure on an investment. Now, this is a way for you to shelter passive income. So if you're saying, hey, you know what, I've got a lot of passive income, whatever. I've made a lot of money in the stock market or whatever, and I really want to shelter that because I'm going to have all these gains. How can I shelter that? Well, if you purchase an investment property, one of the beautiful things you get is depreciation. And in a residential investment property, you have to depreciate over 27 and a half years. But in the One Big Beautiful Bill Act, what you can now do is you could do something called a segregated cost structure, which does allow you to take the non-bricks and mortar, typically in the range of 30 to 40% of the value of the home. So let's use round numbers. Let's just say it's 40% on a $500,000 investment home that you're buying. That's $200,000. You get a first year depreciation. So that's $200,000 of your passive income that you have that you can eliminate your tax liability. That could be huge. And then, of course, that's only on 200,000. Then you do get the other 27 and a half years on the remaining 300,000 to make up the $500,000 home. So that gives you another $5,000 you could write off. So, 4,700, 4,500. So I'm using round numbers here. Ed. So these are things that very few people know about. It's relatively new, but it makes investment properties a great potential. Remember, you have to have the passive income to offset. Okay, it's not going to offset your ordinary income unless you're actively involved. And please consult with your accountant. But it will get rid of your passive income. So if you have a tax liability, what a great way to do it. But in addition to that, you get appreciation, which you will get over time. And you also get the benefit of those rents continuing to go up and cash flowing for you and creating that stream of income. I mean, I talk to a lot of these groups that really just focus on this. These people have become so successful, so wealthy, so financially independent and secure by using real estate in this manner.
Is that going to provide an incentive to build more housing? Because my understanding is we're woefully short in the number of apartments and houses being constructed. It's not keeping up with demand. Is that fair?
Thank you for asking this question because it's near and dear to my heart, because I believe, one of the reasons why we have been able to do a reasonably good job on forecasting real estate is because we focus so carefully on the supply and demand component, and many people do not. So it's just like anything else, just like stocks, it's just like anything, it's supply and demand. So how do we measure demand in the housing market? It's measured by household formations. So an example of a household formation is mom, dad, and a child. They live in a home. Eventually the child grows up and now moves and gets their own place. Well, it's still the same mom, dad, and a child, but instead of one household, they have two. They have formed a household. That's how we kind of measure that. Also divorce situations. But the household formations in the United States have averaged about 1.8 million a year. But as you correctly pointed out, because of the affordability, because of the fact that rents have gone up, people have postponed this. And that has dropped to about 1.2 million over the past year. It doesn't mean it's going to stay at this level. It means that there is now accumulating pent-up demand. Look, people still are going to want to get married. People are still going to want to have babies. People want the garage. They're going to want the backyard. They're going to want the home. So life is going to happen, but people are waiting a little bit longer. It makes sense. Times like this, it slows down. You could see it historically as well. But if rates continue to come down, as incomes gradually go up, you get more equilibrium, and now household formations increase. That can happen relatively quickly because a quick move down in rates, formations jump. Supply, on the other hand, is measured by builders putting up homes. And as you pointed out, Ed, that has decreased. Now, builders were putting up somewhere 1.7, 1.8 million, and it was tight, but keeping up, maybe 1.6 million. But now that has dropped to about 1.3 million. And that's kind of like a big cruise liner. You can't take that and quickly turn around. So what will happen is that as the demand perks up, well, then builders will start looking for land, permits, approvals, and then start construction. And then to completions, it's a few years, 2 years, 3 years catch up, which is why if we're really smart about this, and if we could see the future before it becomes obvious to others, we look at it and we say, you know what? In this environment where both demand and supply are low, demand can perk up rather rapidly, and it's being pent up, especially if rates drop. If you believe that, like I do, that they'll drop a little bit. If you believe incomes go up, I believe that too. Then the demand side will ramp up a lot faster than the supply can, causing an imbalance and creating an opportunity in housing.
You're an expert on interest rates. And at our last strategic investment conference, you were one of the crowd favorites, and you talked about your predictions for mortgage rates. And you were within, I think, a couple hundredth of a percent of being dead on accurate as to where rates would be today. So congratulations on that call. And you did it the year before, and you did it the year before that as well. So you have a crystal ball when it comes to rates. Where are they going? Is there anything that the Federal Reserve can do today that actually brings down mortgage rates, not just short-term interest rates, but mortgage rates?
I'm so glad you asked this question because there's so much confusion about this, and so many people get this aspect wrong, the relationship between the Fed and mortgage rates. And I see it all the time. I see it in the writing. I just saw it from our dear friend this past weekend, by the way, and there's confusion there. Okay. Let's get the record straight on this and let's go with the facts. It is true that the Fed only controls the Fed funds rate, which is literally an overnight lending rate. It can change overnight. Doesn't happen that way, but it could. The longer term end, like the 10-year treasury or mortgage rates, it is a different animal, but there's a relationship between the two of them. There's some arbitrage between the two of them where the Fed funds rate's like the mother's milk. And everything else is going to be, whatever above that, and it can fluctuate. But if we were to look at what people have been saying of late, what they have been saying is they've been saying, well, the last time the Fed cut rates, which is back in the fourth quarter of 2024, and specifically September 18th, then November 7th, and then December 18th, those three instances, mortgage rates went up. Well, what they don't do, the measuring point is wrong. Markets anticipate, markets look forward. So if you look at it from September 18th, the day of the cut, well, it is true that a period after that mortgage rates did go up. But if you were to just go back in anticipation of it when it was telegraphed 3 weeks, do you know that mortgage rates dropped 0.75%? An enormous move in anticipation of it. So people's measuring stick is wrong. In fact, Ed, we see the same thing today. If you look at August 22nd at Jackson Hole, it was clear that Jerome Powell telegraphed a rate cut. Between then and today, mortgage rates have dropped 30 basis points in anticipation of this 25 basis point cut. So you got it already. Now, where do we go from here? It depends. We go back to September 18th of 2024. Why did mortgage rates go up? Was it because the Fed cut rates? No. It was because we got blockbuster job numbers that followed it, which caused the market to say, hey, inflation's going to come back. The job market's red hot. But what we discovered and confirmed with all the revisions of late and today with the QCEW numbers was that 52% of the job numbers that we thought we got on average never, ever happened. And that's a whole other problem with the birth-death model and the faultiness of that. But what we know is that there are reasons for this move. If you look at going back to the 60s, there is a true correlation. As the Fed funds rate moves up, mortgage rates do go up. As the Fed funds rate comes down, mortgage rates come down. Do they go in lockstep? It's not exact, but the trend is almost always in the same direction. So as we root for the Fed to cut rates, if you're looking to see lower mortgage rates, that's what you can expect. So I think a long way to answer your question, Ed, is I think mortgage rates can come down a little bit more. I think the spread is something that's important that few people look at. We mentioned it at SIC. At the time, the spread was 2.8%. My forecast would be dropping to 2.25. It's actually 2.23 today. So what is the spread? If you look at the 10-year treasury and say, what are mortgage rates above the 10-year treasury? That spread historically has been between 1.6 and 2. It had zoomed to over 3% and it has consistently come down. We are now at 2.23%. I think there's a chance it gets lower. So I think my forecast of 2.25 will be proven wrong. I think it will be better than what I had forecast, and that will help mortgage rates come down. I think there's a chance we could dip below 6%, Ed, and I think that spurs a lot of activity. Refinancing it's already picked up dramatically. It's going to pick up very significantly. However, purchases are different. A refinance, Ed, is, I see the lower rate, let me just do it. Right. By the time people look at a purchase and look at that rate and then say, okay, well, maybe I should try and figure out maybe I should talk to a real estate agent. Maybe I should maybe I'll go visit this home in person, shop around, negotiate. We have to have rates sustain at that lower level for a longer period of time to see the lift in purchase activity. I think this time we should get it. There are speed bumps out there. Inflation numbers could surprise us. These tariffs could potentially provide a little bit more problematic inflationary numbers. But I do think that the odds are that we could see interest rates around this 6% level be here for a while. And I think that will create a lot of health in the market and a lot of opportunity.
So if we look at the other end of the yield curve, right, and longer term treasuries, bonds, long-term bonds, how do those rates impact? How does the pricing of the 30-year, for example, impact the 10-year or mortgage rates? And the reason I ask is because globally, there's now talk among people in the circles that you and I are in, talk of a global debt crisis forming. France having serious debt problems, not able to get it under control. Government just collapsed. Japan talking about raising rates more, which is amazing. Italy is always sort of in the background, and so people are wondering, well, what happens in the U.S. to longer term rates as well? Does the yield curve steepen? What would that do to your narrative?
If that were to continue, then we would see longer term rates, inclusive of mortgage rates, likely rise from those levels. So you have a push-pull. Look, it's kind of like a Rubik's Cube, right? There are so many facets, and you are 100% right. And dear friends of ours like Peter Bookbar has pointed this out as well. So when we look at the global landscape, there is reason to believe that the longer end of the curve does have some problems because the globe is very interconnected and yields do tend to rise in sympathy. However, that said, there are a lot of things that are happening in the US specifically that could be a benefit. Let me just point out a couple of them. One is stablecoin, and I'll explain how that works. And two is something called the bank deregulation deal, which is very quietly coming together. About 4 weeks ago, the FDIC and Federal Reserve put a proposal together to do this bank deregulation deal. What would that do? We all know how banks make money. Banks borrow it from me and you at a very cheap amount that they pay us, and they either invest it or loan it out. Now, which seems like a great gig, and it seems like, well, let's do this endlessly, but they can't do it endlessly because you have to protect the depositors. So they're limited. They're limited by saying we have to have our own money, and the bank's own money to back it up has to be about 5 to 6%, big banks 5, smaller banks 6% of that amount. So they can loan out about 20 times what their capital is, or smaller banks about 15, 16 times what their capital is. So what that means is their profits are theoretically limited by the amount of capital that they have, because then they can't take in more deposits and invest it. So one of the things that if they invested in is treasuries. Scott Besson says, why do we want to kind of handcuff banks to invest in treasuries? Because it's a risk-free asset. It's backed by the full faith and credit of the U.S. government. So if they invest in treasuries, let's not ding their capital ratio. So that supplemental leverage ratio should be allowed to do this without dinging it. That means it will make banks more willing to absorb and purchase treasuries. It's brilliant. And if it goes through, it will mean more buying of U.S. treasuries by banks. That would be a big help. The other, as I mentioned, is stablecoin. Now, stablecoin is becoming more and more popular. It certainly is going to be growing exponentially. If you've been watching the growth of it and you look at the trajectory, this will get larger and larger. But why is stablecoin so important? Because stablecoin must be backed by shorter term treasuries. So it has to be backed by something like that. So you're saying, okay, Barry, we've been talking about longer term treasuries, right? Yes, but here's why they're connected. Because Treasury Secretary Besson has the ability to decide which treasuries to sell. So as the demand for shorter term treasuries grows, you take our debt and sell more of it to the shorter term treasury where the demand is. You have less longer term maturities that you're selling, which keeps a premium on those. And then as the price of those remains pretty strong, the yield can be helped by that and get reduced. So that's why those two things are important for us to contemplate. Of course, as I said, it's a Rubik's Cube, and nobody knows for sure. But these are all the things you got to kind of take into consideration.
Thinking back to Silicon Valley Bank, right? There's the most recent high profile bank failure that we've had in many, many years, right? didn't they collapse because they had too many treasuries?
Well, what they had was they had a tremendous amount of treasuries that they were holding on to. And these treasuries were typically with a weighted average coupon of 1.8%. So what happens is that if you take the value of something that's, let's just say me and you, if we loaned out money and we're getting 1.8%, and then rates everywhere else are up to 6 or 7 or 8%, which it was almost at the time, then who's going to want to purchase our 1.8% measly yield if we were to say, hey, would you like to buy this? No, why would I buy that? I'll buy the 8% paper. Now, they will buy it, but they'll buy it at a significant discount, okay, to compensate for that. So most of the time, you don't have to mark that to market. But what they had to do was, because their assets ran very, very low, they had to market, and then they had to sell those. By selling them, it exacerbated their losses, reduced their capital ratio, and put them in a world of hurt. So are there risks out there? You have those, but those are typically mitigated by the bank stress tests and things of that nature.
So is the deregulation push to essentially say you don't have to mark to market anymore? You can hold it at book value?
It keeps all of the regulations and it keeps all the stress measures. All it is saying is the deregulation deal of banks would allow them to purchase treasuries because they're risk-free without having to increase their capital in order to do so.
What can be done, in your opinion, what should be done, if anything, to facilitate the building of more houses? Because I live in Connecticut. I live in a very blue state, and it's full of irony, Barry. And I'm sure you see this all the time too, right? Everyone is pro housing, and especially in this area, like, great, we need more low income housing, and we do. We need places where everyone can afford to live, right? And it's all great until you find out that one has been zoned or sited down the street from your house. Then all of a sudden, oh God, this can't happen. And there's a million reasons why, and nobody ever is honest about it. It's, oh, well, the road's not going to be able to handle it. And the traffic lights aren't built for this. And all kinds of stupid, silly excuses come up to torpedo these projects. Is that a big part of why we don't have enough houses? Is just the NIMBYism?
It certainly is. But then there's also the cost to construct and the profit margins that are needed. And, cost of land's gone up. The regulatory costs and the soft costs are extraordinary. The construction costs are extraordinarily high. So it becomes extremely difficult to actually construct a home that would be deemed something that could be an entry-level home, and if you're going to do so, the profit margin incentives aren't quite there. So there's a few ways you could do it. One is you could certainly subsidize it. So that could be something the government could do in order to construct some of these. So that's a possibility. But then there is another. And, I know that there's not an appetite for quantitative easing, certainly. But if you look at what's on the Fed's balance sheet, it is predominantly, let's call it round number, $6.5 trillion, mostly treasuries, but a significant amount of mortgage-backed securities as well, probably 2-to-1 treasuries to mortgage, again, using round simple numbers. Okay. So what's happening now is there's a runoff of treasuries and mortgage-backed securities. And what the Fed has been doing is and this has helped mortgage rates, by the way, and treasury rates, because what they're doing is they're reinvesting it. So they're not increasing their balance sheet, but with the exception of $5 billion a month of runoff, which is not a lot comparatively speaking, they should have just eliminated it. They are making investments. So they're actually a buyer of treasuries, no longer mortgage-backed securities. I think what they should do is they should actually be reinvesting the mortgage-backed securities that are running off back into mortgage-backed securities. Now, I know they want to get rid of them, but what that would do is, when you have President Trump potentially calling for an emergency in housing and declaring a situation like that, that would significantly help mortgage rates. Maybe get into the mid fives, maybe, who knows, maybe low fives. And that solves a lot of problems for you. That solves a lot of problems for affordability, gets a lot of people out of renting into home ownership, gets a lot of people into wealth creation. And, when you think about what we have to plan for, Ed, is we have to start thinking 10 and 20 years into the future. Because if people aren't buying homes, then 10, 20 years from now, 30 years from now, so many people today depend on their homes for their retirement, for their security, for their generational wealth that they pass on. And because of the wonderful tool of a reverse mortgage, it can generate income. If individuals don't get into the game, not just for today, but for 15, 20 years from now, we could have some major problems with how we're going to do this. And, there's other things we could talk about too. And it's like, I'm very, very concerned with AI job elimination. This is a big problem that people are not thinking about and talking about enough. But all we have to do is open our eyes, take a Waymo ride, go to any fast food restaurant and talk to about,
Absolutely.
And I make the mistake. I do a lot with AI. And when I talk to AI, I literally forget I'm talking to a bot. I'll say like, oh, thank you. That was very helpful. I'm talking to a freaking bot. And I'm like, it shows at least have good manners, but you forget. So there will be jobs that are going to be eliminated. And this is something that I think needs to be at least thought about by everybody's. How are we going to protect ourselves from a wealth standpoint, from an income standpoint?
Couldn't agree with you more. I think that that AI is starting to have an impact. It's just starting to show up in the numbers. I can't point to anything specifically and say, here's the proof, but just anecdotally, I think it's starting to show up. So you've got a recent graduating class generation, if you will, that is struggling mightily to find entry-level jobs. And that probably continues for the next 5 years or so. So you've got a group of, I call them kids, but 20 something, 22, 23-year-olds that are going to really have a hard time finding entry-level jobs, right? So then fast forward 10 years from now, there's no one to be a middle manager because we never trained them in our industry, right? And then those kids couldn't buy houses either. Like everywhere I turn, I find yet another area of concern for the 10 to 20 year out horizon. And you've just illuminated yet another one with housing.
And you know what? And we talked about this together at SIC when I talked about the fact, here, Jerome Powell, job market solid. We showed the increase in continuing claims. And I think this is a real important point because continuing claims is showing us, I'll give you an example. Since January of 2024, continuing claims, meaning those continuing to receive unemployment benefits, has increased by 200,000. Now, that's a big number, but the amount of people unemployed has increased by 1.1 million. So what does that tell us? There's roughly 900,000 people that were receiving unemployment benefits, but have not found a job, and that their unemployment benefits expire. They typically, depending on the state, but let's take a typical 26 weeks. So they're unemployed for longer than 26 weeks. So if you let go, it is something that it's harder to find a job. And we're seeing that in all the soft survey data as well. That's a big concern. And this is why it's so foolish for people on the media, like your Steve Leismans, and of course, Jerome Powell, and it's other Fed members that don't understand this stuff. And they say, well, the break evens, we have this interesting, look at the supply and the demand. We don't need to create as many jobs because initial jobless claims have been relatively stable. These are people who play checkers and don't play chess. They don't understand it. Let me explain this to you very, very quickly here. If it is true that you need less jobs to absorb currently the amount of people that are taking unemployment benefits for the first time or being let go, what starts to happen when those that are being let go increases and you don't have the absorption? If you're not creating the jobs to absorb them, well then, what's going to happen when this ramps up quickly? And it can turn quickly. You and I have been around long enough to see how fast that could happen. Then you have a real problem and it could change quick. What we need to be doing, what we should have been doing, is cutting rates, and probably cutting rates aggressively, probably by 1%. We're going to get a quarter, but I think we're 1% above where we should be. And we need to get there quick because you need to get job creations increasing. And if you get that, then you're prepared for, as people get let go, to reabsorb them and get some of these people off of the ranks of the unemployed and back into the workforce.
I hope Jay Powell's listening, Barry. Thank you as always. We'll see if we can get it in front of him. Barry Habib from MBS Highway. It's always amazing speaking with you. I love it when you bring your passion to these discussions. Thank you so much. You've helped a lot of people over the years, and I'm sure you just did over the last half hour. Good to see you.
It's a privilege to be here. Thank you for being a great friend for so long. I appreciate you.
If you enjoy hearing from people really in the know on the most important issues of our day, please take a second to subscribe to our channel. And if you want to learn more about my own thoughts on these topics, subscribe to my free weekly letter. Every Friday, I send out a new Global Macro Update email along with a link to any new podcasts. There's no charge, and you'll see a link in the description where you can join me and over 97,000 other readers. Thanks for watching.